Alright, so hi everyone, welcome back to our PropertyLimBrothers Invest series. Now today we're going to talk about an article that just came out on Straits Times this morning, and stay tuned.
Wealth management and
Monthly installment at 1.88%
to select the right property to buy.
1 km. It's 1 km.
Yeah, let me check.
Alright, so this article goes like this. This morning when I woke up, I saw this article and I think it's very interesting, so I just decided to do this shoot. So we're in our new video podcast studio. It's still halfway being constructed. There's no glass here, as you can see. So it's going to be completed in a few days' time. Stay tuned. Alright, so let's dive straight down to this article that is published on Straits Times this morning. It says, the yield from CPF, currently standing at 2.5%, may surpass that for private homes according to a study. So now this article says that the rate of return for private properties in Singapore has slipped since 2011, especially when the cooling measures came out to cool the market from the government. And some new properties right now has in fact a lower yield than the country's national retirement plan from CPF fund, which has a minimum fixed rate of return at 2.5%, and this is according to a research from property analytics startup UrbanZoom. Right, so I think it's an interesting article. So we just want to share our opinion based on this article. So if you have time, read the article. The link is just right down below, and let's dive in. Alright, so I think it's very important to see this article from different perspective, alright, because importantly, everybody is at a different life stage. Everybody has needs for property for different kinds of means and needs as well. So you could be probably right now in a position whereby you are renting a place and you have been renting it for a couple of years and you hope to have a sense of ownership in the property. You could also be coming up to start your own family. You no longer want to stay with your parents. You're getting married, you plan to have kids, you want to have a space of your own. You could also be in a stage whereby you already have your own state property and then you want to invest in a second one because you have some spare funds. So I think end of the day, we have to look at the perspective of where are you right now. So let's have a look from a own stay perspective or kind of view versus a perspective of buying this property for investment, because there's a lot of distinction. Alright, so if I want to buy a property for own stay, I'm not just looking at the yield, because there are just so many kinds of intangible plus point to owning an own stay property based on my own preferences or my own upbringing. Now, if I'm looking at this property investment as a point of investment, then yes, I got to look at the yield, I got to look at the performance. There's potential for the next 10, 20, 25 years of my ownership and my rentability and stuff like that. But let's have a look at the first thing that we want to talk about today, is that if I'm looking at an own stay perspective, is that yield really important at the end of the day itself? Right, so buying an own stay property has many different points of consideration, right? So there is an opportunity cost kind of perspective, and there's a lot of intangible benefits. So for example, if let's say you're planning to get married, right? So you want to have your own space, you want to build a family, you want to build a home. This is an intangible benefit because you're going to build your home, you're going to create a new nest with your spouse, and then you're going to have kids. You're going to build beautiful memories in your home. This is intangible and it's very hard to measure based on you perspective from the initial purchase price to maybe 5 to 10 years later, right? So people buy homes because probably they want that freedom to renovate the place as well. They could be renting for years, and they probably could be facing the fact that every 2 years the landlord will call them and say they want to increase the rental, and probably they hate to move after renting for 5 to 10 years. And I think probably they think it's time for them to start to own their own place, have that sense of belonging, sense of ownership, and sense of stability, that they don't have to keep moving every 2 years or be subjected to a renegotiation for rental. Alright, so some people might be looking at that approach. Some people might be looking at an approach that because they have young children, they don't want to move every 2 years compared to rental. Is whether you want this sense of security, and probably some people want to own a home because they want that sense of privacy. You don't have to worry about the fact that your landlord might want to sell the place and then you have people coming in, making appointments over weekends to view the place. So there are pros and cons based on different needs, alright? So rental also has its plus point, alright? So some people love to rent because maybe they are on a very heavy traveling schedule. They move around the world a lot. They just don't want to be tied down by a property that they buy. and have to worry about it when they're abroad. They probably also love that freedom to stay in different kinds of properties, right? So maybe 2 years they want to stay in the condominium 2-bedroom, maybe 2 years later they want to stay in the 4-bedder, or they want to switch developments, they want to switch locations. They just want that kind of flexibility. Another plus point of rental is that you don't have to store up that down payment compared to ownership, right? So you don't have to come up with 25% of the purchase price. You can immediately rent a place and then start staying in it. So what we're trying to say is that if we're just looking at property from a yield perspective, then it basically eliminates all other forms of needs and perspectives already. But I think the first thing to note is that if we're talking about yield, is this from an own stay perspective or is it from an investment perspective? Now, if it's an own stay perspective, then I don't think we should just purely talk about you. I think you is important. If you get to buy a property and you stay in it, your family enjoys it, and your property appreciates at the end of, let's say, 25 or 30 years, then that's a bonus. But end of the day, let's have a look at the worst case scenario. Let's say, for example, you buy a property for $1 million. You buy at age 30. That's your one and only property for own stay. For family, you start to have 1, 2, 3, 4 kids. And then after 30 years, to fully pay off that property itself until age 60. And then you decide that, hey, how much can I sell it 30 years later? So for, let's say for some reason or another, your property did not appreciate. You bought at $1 million. You still sell at $1 million after 30 years. I mean, for some reason, it just doesn't appreciate, just stagnates or something. And what's going to happen? To quicken out the process for you, I've calculated a rough estimate for you, factoring all your stamp duties, your legal fees, fees for selling, maintenance fee monthly that you pay to MCST, some occasional repairs that you have to do, plus your mortgage bank interest, plus your property tax. So let's say your break-even price is at 1.45 million. You bought at $1 million. In total, at age 60, you have paid a total of $1.45 million. And if you can only sell at $1 million, that means technically you made a loss of $450,000. Let's take that $450,000 and divide off by 30 years. And then we divide off by 12 months. How much is it going to be? It's going to be $1,070 per month. That's your cost. That's your loss. And technically speaking, if you look at it from an own stay perspective, if your property don't appreciate, that means that you spend $1,070 per month for your family to enjoy the place that you call home, right? So, of course, if you look at it from an own stay perspective, then it makes sense compared to renting a property at paying $2,500 or $3,000 a month, being a tenant, and you rent it, and you might have to switch places every 2 to 4 years depending on your relationship with the landlord and stuff like that. So if we are just looking at an own stay perspective, there's much more to you itself. Of course, the bonus is that the property appreciates to 1.45 million, you broke even. That means for the whole 35 years, you have stayed in this place for free. You have forced savings. When you sell at 65 years old, you encash $1.45 million, and that is basically your retirement fund. You can probably fully pay off a HDB at 500,000 and keep the rest for retirement and stuff like that. So if it appreciates, it's good. If it don't, then you have to calculate your monthly cost of staying in your home. If it appreciates more than a break even, then of course there's a bonus. All right. So let's come on to the second point. So let's say if we want to base this article to compare on the yield perspective on property vis-a-vis other investment products. I mean, I myself, I invest in properties, I invest in REITs as well, I invest in stocks as well. I look at different kinds of investments so that there are different basket of investments. I mean, for my own preference, I'm not sure about you, but it's important to do a comparison because sometimes other investments do make sense. And we want to make sure that we want to look at different perspectives and not just to narrow ourselves to just investing in property only. So if we are looking at the yield perspective, let's have a look. In general, in Singapore, people love to compare buying a property to putting my funds maybe in a REITs investment fund, or maybe I want to put it in an ETF fund, or I want to invest in stocks itself. Probably something that can give me a rate of about 5% averagely per annum. And if there are dividends, I might just reinvest the dividends and let it compound for the next 10, 15, 20, 25 years. All right? So some of the key reasons that people, of course, love to buy investment products like REITs, stocks and funds and ETF funds and stuff like that is because they are more liquid. All right? So anytime if I need to sell a certain number of shares, probably my kids is going to uni and I need some funds, I can probably just encash a couple of lots and then pay for the school fees, university fees and stuff like that. So it's more liquid in nature compared to property, which is more illiquid in nature, and this gives me a bit more flexibility. Of course, if I were to let it compound and it performs at 5% per annum, after the sales charge, after the whatever trading fees and stuff like that, and I don't touch the money, definitely I think the yield is there, the compound interest is there. You can do your own calculation using a compound calculator. And comparing to property, which is more illiquid in nature, and if let's say this property don't perform, then naturally there will be a loss, because not forgetting that I still have to spend time to manage the property. Because it's an investment property, I need to look for a tenant, I need to repair the property, I need to pay for the MCST, I need to pay for property tax, I need to manage it, I need to make sure that my agent does his job and keep looking for a new tenant after every 1 to 2 years. It's like a second part-time business. You got to be committed to it, you got to manage it. Some of the plus points that we see in the investment property, I mean, if you look at the previous episodes that we have, is that yes, it looks like a second business, but it gives you the flexibility to use it, all right? So you can use it if you want to use it for your own use. For example, you're selling your own stay place, you need an interim place, you can stay in it, or you just want to leave it vacant as a second home, probably for your kids when they grow up, as a gift and stuff like that. It's a tangible asset. You can use it to rent out, to generate rental income. Of course, there is a chance of capital appreciation, and a lot of people buy second properties, third properties, because there is a leverage component compared to buying a fund. I mean, buying a fund has no leverage component in a sense. If you have like $300,000 comparing to buying a $1 million property, you can only invest this 300. 300 will be 300. But of course, if you were to leverage and buy a property, you can go up to $1 million, $1.1 million, for example. And so there's this leverage component. And if it does appreciate in the short term, let's say it appreciates in 3 years, in 5 years to $1.3 million, to $1.4 million, technically your $300,000, when you sell the property from a purchase price of $1 million to $1.3 million, and then you take back whatever you put in plus the paper profit, you have technically sort of like double up the amount. And after lessing up all your fees and stuff, probably has appreciated by at least 50%. Because of the leverage component, there's a chance of probably a faster capital building kind of engine in it, if you select the right property product in a sense. All right, so I think there's pros and cons, and not forgetting that properties also have a chance of an en-bloc opportunity in future, although it's unpredictable. So it's really more of, do you want something more liquid, hassle-free, you don't really have to think too much about it. This is more like a second business. A lot of people go into it because of a chance of having that capital upside. But I think the key thing will be really selecting the right kind of property product that you are entering into. If you cannot find something that makes sense, and you cannot find something that has the potential to increase in value over time, then perhaps it might be wiser to just leave your money in the fund for the time being until you find something that is worthwhile for your time and for your investment. All right, so I think to sum it up, this article is great. The only thing that we think is that we have to look at it from perspective, whether is it an own stay perspective or investment perspective. And we hope that this episode will shed some light and our opinions with you. So we hope to see you soon. Cheers. Alright, so for more information on investing in new developments, do head out to our website at PropertyLimBrothers.com, and as well as our YouTube channel under InvestorSeries, and we will see you soon.